Well, this is week 7 of our class. We have Bill Dixon, a senior client partner from Korn Ferry. I've known Bill for many years. He's one of the top executive comp consultants in the business. In fact, he works for one of the top firms, one of the most prestigious firms in the executive comp game. We're just going to have a laid-back interview. So I'm going to ask him 10, 12 questions. Class will last no more than 30 minutes. If you have any follow-up questions for Bill, you can send them to me via email and I'll forward them to him. So here we go. Bill, tell us about the executive comp industry.
Well, it's a very interesting business, and it has been for the better part of a decade, as we've experienced many changes in the world, both from a business standpoint, but also even a regulatory standpoint. The business of doing executive compensation work has become much more intensely scrutinized, and it's a significantly important thing to almost all of our clients. I say almost all because some organizations don't spend enough time on executive pay. But as a general rule, Keith, I mean, the average board probably spends 4 to 6 meetings per year on the subject of executive comp, and about 90% of all public companies use an external consultant. So it's a big industry, it's a big business, there are many competitors in it, and it is a highly competitive industry from a firm-to-firm standpoint.
So when you say competitive, I'm only aware of 3 or 4 top firms. Obviously, Korn Ferry is one of them. When you say it's competitive, you're just talking about the consulting world competitive?
Yeah. So, Keith, let me ask you a question. Do you remember what happened back in 2001?
Let's see. Was that pre or post Enron?
Let's just say post Enron. Yeah, well, and there were a host of other companies that went through the debacle, but since 2001, with the meltdown that occurred at Enron and several other places like Health South, the whole, structure and method and perspective on executive pay has changed dramatically. That was the genesis of the Dodd-Frank rules, which were put into place in the mid to late 2000s, post-Enron, but also led to a rewrite of the SEC rules on the disclosure of executive pay. Interestingly, Keith, you might find this interesting. My sister, Kathy Dixon, used to work for the SEC and wrote those rules. So this lineage of being in this business goes into my family. But the whole uproar around what happened there and how much risk was being taken, and that shareholders had the right to know what was going on in the boardroom surrounding executive pay has really changed this industry. So it used to be that there were 4 or 5 major firms. There was Towers Watson, there was Hewitt Associates, there was Hay Group, there was a number of accounting firms that did this, and there's pretty much like 5 to 7 major firms. Because of all of the what they call PCOI, perceived conflict of interest, that occurred around consulting firms and accounting firms, the entire industry blew up. So major groups of, for example, my old firm, Hewitt Associates, about 70% of all the consultants went off and formed their own firm. Same thing happened with every one of the major competitors. So immediately there was a move away from big firms that were viewed as having a potential conflict of interest into creating a series of a whole host of boutique firms. And the interesting thing, since the late 2000s and the financial meltdown, there's been a gravitation back towards bigger firms and a consolidation in the industry. So when I say it's competitive, there have been waves of different kinds of competition where everybody was changing their consultant, and more people were competing for the same amount of business. So that was one point. The second thing I'd say, Keith, is that executive pay used to be kind of a legal and accounting activity, pretty much a compliance activity. That really hasn't changed, but what there's been now is more of a focus on pay and performance. So it's required a different skill set and a more significantly strategic role for consultants to help boards make good decisions about how to pay for performance. So most of that was made mandatory by the disclosure rule changes that I mentioned with the SEC, then Dodd-Frank, to ensure that an appropriate amount of risk was being taken with regard to executive pay. But beyond that, as the transparency has increased, more external firms like ISS, Institutional Shareholder Services, have become the watchdogs and the inspectors of the board's work and the executive comp consultants' work. And Say on Pay has become the watchword of the last 5 or 6 years, where shareholders get to vote on their satisfaction with executive pay practices. So competition and complexity, I guess I'd say, is what's played out over the last decade and a half.
So from my perspective, if I'm bringing you into an opportunity, which I know you're involved in a lot of Fortune 500 companies, larger companies, doesn't it come down to your experience, your firm's experience, and the data you have? So if I hire you as a large company CEO, you have this huge database of compensation information. Isn't that database one of the most important reasons I'm hiring you?
Yes. You're hiring me as a board member or CEO to minimize risk. That's ultimately what we see as the most important thing on people's minds. So they're looking for credible, battle-tested, referenced consultants with all the tools and resources that are needed to do the job. So my firm and my competitors all make major investments on data, on technical compliance and interpreting both accounting rules and regulatory functions related to securities disclosure and some of the legal requirements. So they're looking for somebody to give them good advice based on great data to lower or eliminate their risk for fiduciary liability when it comes to governing companies' executive pay.
So you actually have a whole team that supports a client.
Yeah, my own firm, which Keith, I have to say, I'm 6 months into being at Korn Ferry Hay Group, which is the result of a merger between Korn Ferry, which is the largest recruiting firm in the world, with Hay Group, which was one of the larger pay and benefits and leadership consulting firms, a talent-related firm. This is a $1.3 billion company with the merger. And so this 6-month experience, prior to that, I was 30 years at the same firm, which was Hewitt Associates, which I think we share as a part of our background, dating back to 1986. So Hewitt then merged with Aon. It's one of the biggest firms in the industry, and now I've gone to a smaller firm, but more focused on the area that I've chosen to do, which is executive pay. And that's one of the reasons why I went to that firm. But that gives us the kinds of resources and focus and the ability to align executive pay with talent strategy, for example, which I find very important to the work.
Do you ever find a conflict of interest with the board and the CEO?
So we're going right to the horror stories, huh? I think there are two levels of conflict of interest. One is a legal definition, and another is a practical definition. And I think that if we step back for a moment and look at the history of this area of practice, many boards were formed originally not through an objective process, but through CEOs finding people who were colleagues or acquaintances or high reputation people to join their boards. And many times there was a personal relationship there. They knew each other from maybe some fundraising activities or some civic activities, or even worked at the same company. So the history of the way boards governed executive pay, back to your question about conflict of interest, is not that there was an overt conflict of interest, but a perception that the board was selected by the individual that they were supposed to oversee the compensation for. So that created sort of this perception that there was a good, positive, maybe beneficial relationship between the two. I think that's been largely since 2001. That's been the focus of regulation and scrutiny to eliminate any perception that there could be a conflict of interest between the board and those governing, or the board governing the executives and their pay.
So if I'm a partner or senior at an accounting firm, and most of us in this class will either be a partner or a senior or are already, when they're working with the CEOs on strategy and compensation comes up, and we don't play in the compensation game, what's the best advice that we can provide that CEO or the senior team?
Well, that's an interesting question, because if you go back to before 2001, many of the large and small accounting firms had their own executive pay practices. You'll notice that none exist anymore, or very few do.
Yep.
And the reason is because of that perceived conflict of interest issue. So back to your question, if you're a CPA and you're advising a company, the best advice you can give to your client is to really look at and seek the best partner to help them be fair, effective, pay for performance, and be transparent from a disclosure standpoint, which directly comes to bear, say, the work that the CPA is doing. I've often, in my business, asked to refer people to accounting firms, so I'm often asked to give a reference or a referral to people who have high credibility and a great track record. I would say the same would apply to the accounting firm giving a referral to somebody in my business.
Makes sense. How about I just throw some terms in the executive comp field, and I'll let you fire back on your thoughts. You ready?
Sure.
162M.
To ensure that anything that is a deductible expense as it pertains to executive compensation is performance related. That's really the gist of 162M, and what matters to boards is ensuring that as big a percentage, if not 100%, of what is paid to executives is a deductible expense under 162M. It's actually a fairly tricky subject. It sounds very straightforward. But for example, of course, base pay, even though you may give pay adjustments for performance, is not deductible. Some incentive plans that look like they're performance-based are not deductible. So the key is really looking deeply at what you're designing to ensure that there's a fair balance between fixed and variable comp, and that variable comp is deductible because it's performance-based.
Yeah, I've never understood the CFOs being excluded from that, but that's just opinion only. So here's the next one. We talked about this offline before we hit the record button. The CEO pay ratio rule.
Yes. It's complicated, Keith. It's in fact, I think we're now getting close to 8 or 9 years since the introduction of the regs, they still haven't determined the exact rules and application of those rules to the disclosure side. The momentum around this was high at first, but has dissipated over time because most employers, A, couldn't understand what they were supposed to do from a mechanic standpoint, and B, are very dubious about the value of pay ratio disclosure. The ultimate result of this will, once it does actually make it to if it does make it to the proxy statement, is what will it mean? And will it matter from a shareholder decision-making perspective?
Makes sense. Here's a topic we've been talking about on our discussion boards, and it's we have a fantastic class. It's going pretty in depth on the expensing. So, what are your thoughts on stock option expensing? Knowing that you and I, when we first got in this business, we didn't even have to do it.
Right. So, I'll be honest. I've been doing this now for close to 31 years, Keith. And the idea that stock options had no cost was absurd, to really put a precise statement on it. There was a transfer of wealth, and stock options ultimately ended up being worth something, hopefully, to most of the people who received them. So when the FASB rules came into being, actually more than a decade ago now, the idea of identifying what the expense and value of stock options really started out kind of in the same place, but have diverged. So the point of expensing stock options for most employers, most of my clients, is ultimately about minimizing the visual expense of stock options. The ultimate end game on the compensation side is to try and demonstrate a competitive to even a superior value to the executive. So one thing that I would point out about disclosed stock option values when you look at a proxy statement is that most employers are trying to keep that cost as low as possible. That has two reasons. First of all, it makes their profitability higher. The second is it makes them look better and more responsible to their shareholders. On the other side of the table, in the boardroom, and when executives look at their pay, the reality is they look at stock options on the basis of 2 points. One is, what did I get those shares at, what price? And two, how much can I make off of them by moving the stock value? That's ultimately what they're worth to an executive. Those two things bear no relationship to one another.
No. Just out of curiosity, how many board meetings do you attend as the consultant?
Well, there are 200 working days in a year, and by my last count, my biggest number of comp committee or board meetings in a year was about 90 days.
Wow.
So if you think about that, that's a lot per quarter, Keith. And there's an awful lot of preparation that goes into a board meeting. So the way I'd like to put it is I spend hours, days, weeks preparing for a 1/2 hour presentation that has to be exactly right.
Wow. I'm going to go back to throwing out these short questions. Golden parachutes, handcuffs, are they still a big part of executive comp?
Yeah, the prevalence of parachute payments has dropped like a rock since the rules, the 280G rules came in and became a reality. So I'll bridge over to horror stories as I talk about this. The objective of any poor CEO, and some of them even good, are to maximize their severance payment their parachute. And the goal of any company is to minimize that and avoid going over the trigger. It's interesting to have watched the dynamic through the early to mid 2000s when there was a bit of a mania around that, and more than half of the companies would gross people up for exceeding the 280G limit, to probably less than a third today who are not capped at the 280G limit and can receive massive payments. I don't know if you remember some of the names of pay for failure. That's the term of art. Carly Fiorina, Bob Nardelli, among others, who received large severance payments upon termination. That ended up costing some of those companies a great deal in terms of image and brand, because shareholders viewed that as a huge waste of money.
Yeah, we spent a lot of time talking about those in our brick and mortar classes. How about the handcuffs? We see any of those?
Yeah, I think that, as we've been through turbulent times since the Great Recession in 2000, starting in 2007, there have been a lot more questions and interest on retaining executives through turbulent times, Keith. And I think the idea of having golden handcuffs or restricted stock arrangements in many cases, or even restricted cash payment arrangements that help to retain executives, has resurfaced as an interest area in a lot of different industries. So I think it's being used more judiciously and in a targeted way, very much focused on the value of talent instead of level of the organization. So it's much more, can I use this word, discriminatory in that sense? But the practice has shifted from I want to keep all my VPs to I want to keep that VP, and designing individualized golden handcuff arrangements for them.
Oh, that makes sense. I know you work in the public and private sector. What do they have in common, and what are the differences?
Yeah, Keith, I mean, one of the things that I spend a lot of time in by choice is working with not-for-profits, in addition to public companies and private companies that are for-profit. And aside from the tax code distinction, there is very little difference between them. That is, unless I'm a charity, and everybody that works for me is clergy, most have the same interests, concerns, goals in life, wealth accumulation, expectations, and so on. There are differences that way. But ultimately, the board is concerned about doing the best things, the best practices best, and it doesn't matter what industry. So I see a lot of crossover and, interest in what for-profits and not-for-profits are doing to govern and be transparent around executive pay. Obviously, the big difference between the for-profit public company, the stock-owned company, versus private companies and others is just the whole use of equity. But, for example, many private companies may be held by private equity companies or venture capitalists. They try and create synthetic equity to focus and direct the interest of executives towards the goals of the private equity venture capital firm. Not-for-profits have very similar concerns, but have to be creative because there is no value to a not-for-profit. So they're ultimately looking for ways to determine what performance is and drive it through performance plans. But all of them are trying to govern well, be transparent, and avoid the risk of having their reputation and the credibility of the board members and the credibility of the organization damaged by actions taken on executive pay.
Yeah, it's interesting. Listen to your answer. In the last 5 minutes, one thing I keep writing down is I asked you the question about how many board meetings you attend, and you answered board meetings and I'm going to call it compensation committees. Are those becoming popular in the, I'm going to call it the public sector, the not-for-profit as well?
Yeah. Keith, I'll just give you the sort of life of the consultant. If you look at the quarters, that's our busy times. Late January, early February, almost always have a comp committee meeting. Usually you're asked to go to a board meeting and report out. Then you might have a string of them in April, May, June, sometimes two, sometimes three, as people prepare for, they finish up their prior fiscal period and they're paying out and making determinations, and they're planning for their next fiscal period. Many people do their comp studies in the middle of the summer leading up to the fall. So you hit somewhere around October, early November, you have a slew of meetings, and then sometimes there's a year-end meeting sometime in December, usually at a nice resort in California or something like that. But, ultimately, most boards meet minimum of 4 times a year, sometimes 6, and they usually have committee meetings around the board meetings. I would say my average compensation committee meets 5 or 6 times a year. So you put the two together, I might be with a client in their boardroom 7 or 8 times a year. It's a very relationship-oriented thing. It's also a high trust factor hire, and very important to board members to have somebody they can count on to help them make good decisions. And that would be another point of philosophy that I'd make here, is I really kind of look at my job as an executive comp consultant, a board advisor, to be like a board member. Think like a board member, and to be in, have one shoe on as a board member, and the other shoe is really I'm an expert in what I know how to do. And, I spend a lot of time on it. I've spent over 30 years doing it. And so, to me, what I'm offering them is both perspectives. That actually is something that's changed in our field. It used to be, I'm the consultant, I'll tell you the answers and I'll leave. It's very different now. They view you as really somebody they trust as much as their peers in some ways.
Do you have more risk today because of that change?
I think I've always had risk. It hasn't really changed.
That makes sense. Before I ask the closing question, how does somebody get into this business? Because I worked with a bunch of you guys in the 80s, and most of us don't start. I obviously didn't end up in executive comp, but most of us don't start in executive comp. How do we get there?
Everybody has a different pathway. It's interesting you asked that question, because I'm a bit of a, I'm a bit of a unique case in that I came into HR as kind of a generalist and worked my way through being a compensation person. And my basic skill was in doing compensation studies for staff jobs. So it's very unusual for somebody who came into the field doing staff compensation to move into executive pay. Most people that get into the field have started an accounting firm or have started at a law firm, find that they enjoy the kind of the technical nature of the work, and if they're good with people and can stand in a room of highly powerful and highly experienced people and do their job well, they end up in executive comp. So I have to say, Keith, after really 30 years of doing this, most of the people that I've met this wasn't their first job out of school. It was their third job. And most of them that get into it, that are serious about it, stay in it over a very long period of time. I see very few people start out in the corporate side, get into consulting, become an exec comp consultant, and go back to corporate. because the work is very unique. It's highly variable. Each client is different, and the value of the consultant is to be able to bring all those stories and experiences to your clients.
I agree. I think it's got to be one of the most stressful consulting gigs out there. Just pretty easy to hear in 20 minutes. All right, so before I ask that last question, you talked about how you started in comp studies. How hard is it to do regional comp studies?
Comp studies are not difficult to do in the sense that you're gathering statistical information from companies and pulling it into a database. What's difficult about surveys is being able to use that data and interpret it effectively. So regional studies, I find I've been around the country and have worked with a lot of different kinds of clients, so it's not unusual to see a Minneapolis-St. Paul Personnel Association comp study, or I used to work on one for the locations of Blue Cross plans nationally. So that's not unusual, but quite often most employers beyond a certain pay level, Keith, they end up paying on a national basis anyways.
Oh, yeah.
So I've seen the number of regional or local comp studies kind of go down.
Very interesting. So what you're really saying is that paying for a customized regional study might not be worth it. I don't want to put you on the spot, but that's kind of what I'm hearing.
Well, it actually would be worth it if I'm in a market like San Francisco or New York, or highly competitive, high wage market. Yes, it would be.
Yeah, that makes sense.
But to do one in Sioux Falls, South Dakota, or Omaha, Nebraska, I'm not so sure would be that useful.
No, that definitely makes sense. All right, so we've almost taken up the 30 minutes here. I want to close on, before I ask you this, the last question is, for the class, I'm posting 4 great articles from Bill's team. They're right from the Korn Ferry Institute site. Fantastic stuff. How does anyone reach you in the class if they have an opportunity? Is it an email? Is it a phone call? Do they have to go somewhere else? Because you're obviously the expert. You're pretty high up. I mean, I know you always respond to me.
Yeah, that's because I know you. But no, but first of all, one of the things that I think people who've been in an industry like this for a long time, most of us want to see and find really great people and help people. So it shouldn't be viewed as something anybody shouldn't try and do. So, Keith, I'm on LinkedIn, and most people would be able to find me there. And in addition to that, what I can do is share my contact information with you, Keith, and you can distribute it to your class.
Got it.
And I'm happy to talk with them. If anything comes up in their own companies they need some help with, I'd be happy to help or direct you to the right place.
You've always been fantastic just providing information for me. Okay, so we're going to close with the all-important question. Best practices for companies in the executive comp field.
Okay. So the best practice is that the board is the overseer and management is the manager. So there's a distinction between somebody with a fiduciary duty for oversight and a managerial duty for management. So being clear on who does what and where the line gets drawn is a best practice. That's a fairly deep subject. Governance is a very important part of the work that we do. And in fact, our practice is called executive pay and governance for that reason. The second thing is that everybody wants to know what they're getting paid for. That's the executive's point of view. And any stakeholder wants to know that they are paying for valued performance. So the clarity and transparency around what is performance, how do we measure it, who's responsible for it, why do they get paid what they do, is defining performance and paying for it is a second major area of best practice. And if you look at all of the, I guess the regulatory and quasi-regulatory side, that's what's important. The third area of best practice is what I would call the red face test. Is never do anything that could end up creating a red face for your board member. So
Excellent.
some of the things that we talked about earlier, the golden parachutes and handcuffs and some of the sweet deals on the executive employment agreements, paying 10 years worth of severance because you have a 10-year employment agreement. There are some things that if you look on some of the quasi-regulators, ISS being the primary one, look for and look out for and avoid what I would call egregious or questionable executive pay practices, and there are quite a few of them. I think the fourth best practice is that the more you can create a proper balance between fixed and variable, and then on the variable side between short-term and long-term performance, at least you've set up an architecture that supports strategy. That's a very in-depth conversation, that last point, but effectively designing incentive compensation is probably one of the more important best practice areas, and there's a lot of interest on that very topic among boards and external commentators.
Oh, this is awesome stuff. I appreciate your time for 30 minutes. I'll post all your fun information in case anybody wants to reach out to you with a question, a client question, or opportunity. Again, thanks, Bill.
Okay, I want to say this as a comment to the class. Class, you have a great instructor. Keith, thanks for taking the time to include me in this process, and I wish all of you the best, especially now going into December in Minnesota. Take care.
Thanks, Bill.
Bye-bye.